Welcome to Stock Odds, odds and end of 23, start of 2024 edition. Good evening, Rob.
Hey, good evening. Yeah. So, yeah, we're at the gate. We're at the door here, and a new year is ahead of us. What kind of year will it be? Have you guys done your black swan assessments, your gray swans, and your white swans? Have you done all that? I think what I hear from a Bloomberg wrap up was that most people got 2023 wrong. Because they had forecast a recession and all kinds of things, and that sort of didn't play out. And the Fed kind of did okay, contrary to what was expected. So there you have it. You can still hear me, right, Davey?
Yeah, your audio is good.
Okay. All right, let's get through this here. So first thing is I put the daily of the SPY going back to last December here, so you can kind of see right at the end of the year, because we had quite a bit of tax loss selling in December, and so we came out of that. We started January 23, kind of not at the lowest of the year, because the October 15th was or 13th, October 13th, I think, or 15th, whatever, of 2022 was the low on that GDP numbers. Or no, it was CPI, wasn't it, Dave? CPI, yeah. We opened way down and then rallied, and that was the low. But this got to a pretty good discount as well for the year, and then we rallied from there, and then pulled back into banking crisis, regional banking crisis, and then we rallied again, and pulled back a little bit in our softer month of the year, which is September, and that played a bit into October as well, because we finished October right on a oversold condition, and November 1st we took off and rallied through November and all through December. So that's where we sit, pretty elevated. Of course, everybody looks at that and goes, well, it's got to come back down. Well, then you could have said that all the way through too, right? Doesn't have to do anything it doesn't want to do, right? Markets can do whatever they want to do. So the Qs had been stronger than the other markets for the year, and they've held up pretty well. And the same thing coming off the lows at the end of last year and rallying pretty strongly all the way through. That held up better in the regional banking crisis because it doesn't have the exposure to financials like the SPY does. Then we have the diamonds, and so they didn't really, they weren't down as much last year as what the Qs were. I think we had 9.7 or 9.1% performance, something negative for the year of 2022, and just basically stayed kind of sideways and laggy and did not really participate with the Magnificent Seven taking the NASDAQ 100 and the SPY higher. But then later here, coming off these oversold conditions in October, suddenly the diamonds put it into high gear and rallied, and also a lot smoother of a rally, less volatility along the way, less gapping and things like that. And partly because, again, they don't have that exposure to just a few symbols, because it is a price-weighted market rather than market cap weighted. So this a little bit smoother performance, but it took all year to finally kick in the Dow 30 here. And then we have the Russell 2000, and it had a good summer rally, but it did not participate as much in the rally of the year as the other markets. Until so it was similar to the diamonds, and then until November it took off, but it was quite volatile along the way. Some good gaps there. So that's the Russell, and now it's been doing quite a bit better lately than the other guys. And here's the sector performances for Friday, which we had up here. So Friday was slated to be a slightly down day, last day of the month, a little bit of deleveraging. We had questioned or speculated whether there might be some window dressing versus, risk reduction or taking some profits. There was a few symbols that probably had tax loss selling, but those wouldn't be the ones that would have impacted the market that much, because most things got carried along and did pretty well for the year. But on this last day, we did have the US dollar rally slightly. We did have the treasuries sell off and the yields rally slightly, and that knocked down the real estate on Friday. Consumer cyclical was also not performing where it was. Everything went kind of more to the defensive on Friday. So consumer defensive was on top, was actually green. Healthcare was next, utilities, industrials. Basic materials was down in the bottom three there because US dollar rallied a bit. But for the week, we had some mergers in the healthcare space, and that really boosted the performance for healthcare. Consumer defensive was also, people just didn't want that to get additional exposure to all the things that have been up so much this year, and we're kind of getting a bit top heavy. People are expecting, potentially a bit of a pullback. So it was some of the laggers and ones that haven't already run so much that money flowed into, and that we saw that in the defensive. Utilities has also been really down for the year, so that popped up a little bit. And then the 1 month real estate did well because of the interest, and that was mostly boosted from the FOMC meetings, where we had such a dovish runway ahead. It seemed that real estate really rallied. Okay. So this was for the week here. We saw energy hurting the most and consumer discretionary. But you can see the theme for the whole year pretty much in energy, not participating, as well as utilities, mostly not participating, except this last quarter, they did perk up a little bit. And best performer for the week, we said consumer staples, which again, first part of the year, not doing too well and starting to come around. So utilities and consumer defensive or consumer staples looks like they're getting a little bit more allocation of capital. I mean, it's not that the capital's leaving the market. It just needs to find maybe a safer place or something more discounted or more appealing under the conditions that we see. And as we look forward, people are unsure what next year holds. We can look back and say, we know we've had a good rally. We don't know exactly what's going to happen next year. Energy just can't seem to get a break at all. It's pretty volatile and really hasn't gone anywhere for the year. Look at all the agendas in planning for, say, new car sales by such and such a year to be all electric. We're heading that way, and maybe they're just thinking we're getting way out ahead of this. We're not going to need oil anymore. Of course, everything's made with oil too, until they find a substitute for that. So I'm sure something will rally oil and energy markets again at some point, but this past year is certainly where the trade has not been. All right, relative volumes.
It's kind of strange because we had all that geopolitical risk, and if it can't rally in this environment, how's it going to rally if things calm down?
Yeah, well, we didn't have as an aggressive a hurricane season too, so we had a bit of premium in the summer that kind of came out of there too. Yeah, but you're right. I mean, it's like it did withstand the stronger dollar, and then when the dollar weakened, it should have put a little bit more of a floor under it, and it didn't. I think it's really just looking forward with all the agendas related to the environment and It just doesn't seem to be a future climate of favorable to fossil fuels, right?
Yeah.
I mean, in that sector, there is solar too, so it's not completely oil, but oil's just been declining. So now here's the map of the market for Friday. You can see the Mag 7 not participating, but not getting hammered that much either. Tesla's been a bit weaker, but uh, you can see the green spots kind of through healthcare and consumer defensive, a little bit of industrials. Restaurants are in discretionary, so it's kind of interesting. But discretionary is down, and it's really this weight of this Tesla, Amazon, which isn't really fair to the sector of discretionary, because it's just, you know, should Tesla not be moved into industrials? Maybe. You know what I mean? Like,
Yeah.
there are some arguments that are they really that cyclical? Um,
Or go into
but this is,
technology. I mean,
yeah, I mean, this is the problem, right? Is like, where do you stick some things? And I mean, Tesla's largely a battery company, and now they've got other aspects like with the charging systems and stuff like that. Would you say that if you're selling charging systems, you are that much of a are you in audio manufacturing? Like, should you be in that industry, or should you be over in industrials, right? I don't know. I mean, there's debate for everything, I guess. Um, telecom, we had, I don't know, T-Mobile was on fire pretty good for a while there. Here's the map of the market for the week. So you can see AMD. AMD's been on fire compared to many of the other semiconductors. Started already before Black Friday, right?
mhm.
So it's been really strong for a while. And a couple of these reds we talked about last time too. There's still this is still leftover hangover from the earnings and stuff like that. Energy down. Communication services haven't been performing that well overall. Tech took a little bit of a break this week. And then here's for the month. So mostly a good breadth of the market month, and that is what historically December, you know, has and how it performs. The breadth is usually good, and so pressing that breadth, focusing more on your long side rather than so aggressive on your short side, are all part of November and December seasonality. And no matter what the conditions of the years are, even 2022, like I said, we hit the low of the year in October, and there were some stocks that did pretty well before the end of the year last year. And that movie's been repeated for years and years and years and years. So next November, remember that. Well, we'll be in an election. That'll be interesting. So, could there be some stuff that happens? Yeah, could be crazy. I think expect just what, as we came into 2020 and we had things start to get really crazy. There's something about looking forward here into 2024, and we might have a bit of a repeat of some surprises and weird things that happen. So there's a lot of fragility around the world, and expect the unexpected is what I would say for 2024. So expect the unexpected. Anyway, so that's for the month. And then this is for the year. And to look at some of these performances, NVIDIA 238%, Google 58%, Meta 194%. I think that was a big surprise for people. Maybe not as much the NVIDIA, just because of the AI. This already started in April, May to really get those tailwinds. But I think Meta was a big surprise. And something like Apple, such a huge conglomerate, Apple and Microsoft both to be up, 48 and 56%. Amazon, it seems to be gaining traction in so many areas. And I think most households are just finding that based on the amount of trucks that are running around the neighborhoods and how frequently they are, there's a lot of shopping that's been switched to Amazon. So I don't know if that translates into profits that can back up that kind of performance or not. I haven't looked into the fundamentals, but they certainly are dominating in the business area, and even in Amazon Web Services has been a big profit center for them, of course. Tesla up 100%. This is more of a, market stock. Berkshire B up 15%. That's kind of more like what should be normal in a year, not this 238% kind of stuff. Now, Pfizer and Moderna both not having a very good year on the back of a decline the year before as well. So they really hit their peak at in the adoption cycle of the vaccines, and since that tapered off, they've just plummeted. I mean, huge declines in that. So that's where there might be some tax loss selling, is Pfizer, Moderna, even BMY. Maybe some of the utilities, they didn't perform well. Oils, I don't know. Overall for the year, not down like crazy amount. And I mean, would people take tax loss selling on Coke, Pepsi? So they might. We might. This is an important snapshot for you to take and notice as we go into the new year. Is money starting to flow into these ones that are down? Right. Right. Just really start to watch for that. Right. That's more important than watching to see if money's flowing into Nvidia after a 238% up year. Right. It's more important to watch what's happening here, because if you can see this rotation, that all of a sudden they're finding the consumer defensive, healthcare, utilities, even some banking. If they're finding that more attractive, then I would lean into that, because that could persist for a while too. So, and if we have any sign that they want to sell the market at large, even though we have that dovish runway from the Fed, but if you get any indication that they're just, this is going to be the opposite of last January, I would definitely work with it, right? That might mean that something more is coming down the pike, and the people in the know might be selling the market. I don't know, but just keep your fingers on the pulse of whether there's an appetite for more risk taking, whether the risk on is going to be the theme for this year, or whether we're going to shift to more defensive risk off. It's going to make a difference in your trading if you get that right early on. Okay. Here's the VXX. We had been expecting a decline. We said after this last little pop-up, expect it to go back down again, which it is. So again, that heads towards 10 to 12 usually, then it does a reverse split back up to 40 to 45. So keep your eye on that. Let's pause right here for a moment and let's run through just some of the other futures out there. Let's see here. Let's grab this. I didn't snapshot everything, so let's just see what we got here. We could look at our crypto first here. So, I mean, there are discussions for approval of these ETFs and things like that, and yet we've been in a pretty sideways thing. There was a lot of speculation calling for Bitcoin at 100,000 or even 1 million again. So, but you can see it's sideways and stable. I would say that it might get some traction if it can break through past 45,000 again, but really stuck in a range between 40 and 45. On that, back to over here to, so let's go to energy. Let's look at oil here. This is West Texas crude. we can see that did have a rally back to 75 and it's falling again. So it's still under the 200-day moving average. I mean, it's most likely stuck in a range here between 65 and 75, I would say, going forward. And we have had years previously where January was actually, the low. I remember even on the futures magazine, it said, code blue for crude. How low can it go? And it was down, it was trading around $10 a barrel or something crazy. So, expect it to be in the 65 to 75 range. And if it breaks 65, there's something dreadfully afoot with oil. So that's that. Let's go to metals with our gold here. Gold and silver. Holding up remarkably well. Again, some of the decline in the dollar has really helped this move overall in the last couple months. And the dollar's declined because of the Fed stance on no more hikes and potentially a cut in the new year at some point. Well, that really boosted things here. And as far as the metals go, it looks like platinum doing really well. Copper is your recession indicator, and it's slowly moving up, which is good. Means less chance of a recession, more in keeping with the narrative of a soft landing still. Let's look at the US dollar here. And there's been the slope down, anticipating, and then finally getting the real meal deal on December 13th, and boom, down we come with the lack of a hike and telegraphing by the Fed of interest rate cut. Okay, I think that'll cover that. And then going over to seasonality. So what do you see here, Dave, with the January seasonality? You guys can go and plug in other symbols. If you choose ETFs, then you can plug in other ETFs. If you choose stocks here, you can plug in other stocks. But what do we see here for January, Dave?
Yeah, the first day is a little bit muted. I mean, it's not that exciting, but that first Friday has probably the best performance of any of the seasonalities for the month, with the Spider 0.62 and the IWM 0.29 positive. So that could be interesting. Of the 4-day week we have, maybe it's going to be loaded more towards the end there. Yeah, the first day it's like 53% up and 47% down stock. So it's not that bullish.
Well, here, I mean, just looking at this, it seems that maybe people don't know quite what to do on the first trading day of the month. But by the first Friday, you're sort of after the Santa Claus rally, which is sort of the last 5 days and the first 2 of the new month, right? But see, you've got a shortened week, right? We only have Tuesday to Friday, so things kind of get compressed, and it's likely that just the end of the Santa Claus rally kicks in on that first Friday. So
yeah,
keep that in mind. And then we have on the 9th through 14th business day, we have this lull. I'm not sure why that it would be historically like that, other than maybe it's something to do with the tax loss rebuying of anything historically. More kicks in the the third week or something, and ending in the third Friday expiration. And that is not a quarterly expiration, it's just monthly, but it might have something to do with it. And then this is one of the months that the last trading day is actually positive. Most months, 9 out of 12 actually have down last days. So let's go to the first trading day of January for ETFs.
Yeah, that's what we see, 53% positive versus 40% negative. So it's pretty balanced, just slightly bullish. But the kinds of things that are doing better typically are some of the more risk-on stuff like chips, SMH, the RKK funds. Gold is better, and then things like real estate are weaker, utilities, basic materials. So it's a little bit mixed, but still a bit more risk-on kind of things, XLC, XLY. So a little slightly bullish tone there.
Yeah, it doesn't like utilities just finished last week on a better note. That's definitely one to watch, just because they did have, even though they didn't do much for the year, they did have a little bit of a run ahead of this first day. So this is going to be kind of a tricky one, because seasonality should suggest that we might want to sell utilities and real estate, which would mean that the treasury yield would probably be rallying a little bit, putting pressure on these. And if we come in and there's another agenda, which is, let's buy, the utilities and state like consumer staples and stuff, let's buy these. So it's you're going to have to pick up some clues in the morning pre-market to see if you can figure out what the sentiment is. So we have our seasonality data, and yet we only have the probability of that. Contrasting that and allowing in our scenarios the potential for it to be the opposite of that. Right? So GDX and GDXJ would benefit more, and silver, gold, and XLE, all of these would benefit more from the dollar declining, right? So if the dollar is declining, usually that means the yield is also declining, right? So keep that in mind. And here's for the stocks.
Yeah.
What we're trying to do again is line up any stocks with the ETFs, so you're on the same side. What do you see there?
Again, we see GOLD, gold, the high beta stuff like ARC funds and Enphase, Baidu, SEDG, so First Solar. So that verifies that's the trend. And then the short side, you've got some utilities there, NEE.
Yeah, that would be a good one, right? Like if utilities were actually going to sell off, you got a pretty good probability of good performance down on NEE for the first trading day. So you're in alignment then with the ETF and the symbol.
Then you got some healthcare there like Dexcom. So there's some plays here.
Okay. First Friday of January for ETFs. So we're coming to the end of the week, shortened week. And what do we have? We still have some of the same theme. So it's not contradictory, but it's even more bullish.
So 91% to 9.
So the pressure is building onto that Friday. And yet it is a Friday again. And if we have any negative events over this weekend, geopolitically, and possibly an escalation into the new year, I don't know, maybe it's a new year, people go crazier, they get crazier, whatever. If we see that, then the Friday may slice this bullish tendency down quite a bit, just because of the over the weekend geopolitical risk. Okay.
Mm-hmm.
So again, I'm always trying to provide a balance between a data-driven approach and then something comes along as a macro that needs to be paid attention to. If the macro aligns, then great. You're probably absolutely fine to do everything that you see on a data-driven approach. But if the macro opposes it, then maybe I would go into a more sector-neutral approach, right? If you can't get a read on it one way or the other, it's better to be as neutral as possible, and that's by doing sound pairs. So instead of just being long and short in general, or being long only or short only, I mean, you're actually balancing it out so that you're de-risking as much as possible. So when the conflicts are high, that's a better approach. When the ducks line up and conflicts are low, maybe you can go in the direction of the river. Okay.
And most of the stuff is aligned with the first day of the month, but you see gold flipped. It was bullish on the first day. Now here on the first Friday, it's pretty weak. So
yeah, that's a good thing to point out, that it did flip for sure. Yeah. Okay. All righty. And this is the stocks for that same first Friday.
Very similar to the first day.
Mm-hmm. Yeah. There's some good ones in here, some good selections. Just remember too, so when you have the 75, 67, 80, a much better probability skew for that performance than when you see stuff like 50s or less than 50 over here, right? So again, the higher this number, the greater the probability of the downward move of this magnitude, right?
Yeah.
Okay. So that's the seasonality for next week. And we looked at for the month as well. Important to keep your eye on that. Now we're coming to the Fed calendar here, or not just the Fed calendar, the economic calendar in general, but we do have a few Fed speakers again. It always seems to be that way these days. What can you tell us, Dave?
Yeah, Monday, of course, the holiday. Tuesday, there's a manufacturing PMI number. Again, these are kind of surveys that help us know if the manufacturing sector is staying stable or growing or contracting. But it still looks like it's 48.2 is expected, so that's still showing slight contraction in manufacturing. And then there's also construction spending. We're expected to have slightly modest growth there. So it's not like the economy is roaring high or it's suddenly crashing. So those are the numbers to expect there. Wednesday, we have Richmond Fed President Barkin speaking. Again, every time they speak, it gives us some insight as to what their minds are thinking as to keeping interest rates the same or decreasing them. We also have job reports on Wednesday. Employment looks still stable. That's a stable job market. And the non-manufacturing index is also on Wednesday. And that's showing
This is the big one, though. This is the big one here, the minutes, because like December's meeting was so incredible. Mm-hmm. How it impacted risk on assets, how it impacted the small caps, in general, just the explosive move we had up on Wednesday and Thursday following. And then, of course, it, kept things pretty elevated and buffered any of the profit taking that might have happened. And so we're going to get the minutes of that meeting. I think that's going to be a market mover.
So that's probably the key event for the week. Yeah, I think that is the key event for the week, and that's the thing there.
Okay.
Then Thursday there's some more ADP employment report, and Friday there's employment reports as well. So the themes are assessment of manufacturing and the economy in general, and then the minutes of the Fed to show insight as to what the Fed might do at the next meeting.
Right. So these are all December ones. We've got some of these are from November in the Tuesday, like construction spending and job openings, but the rest of them are all from December. So, fairly impactful, I would think. But like you're right, Dave, I think the minutes is probably the biggest event of the week, other than if somebody from the Fed does say something they shouldn't be saying. Maybe something they didn't get the memo on. I don't know. But we always have to be vigilant and make sure that, we're not going over these times of day without our eyes wide open, without being hedged or being ready to hedge. So these are important times, especially the 10 o'clock pivotal time. You can see the market move a lot at 10 o'clock. We get ISM manufacturing on Wednesday, so you could even move then before the 2 p.m. meeting, not meeting, but minutes report. So anyway, appreciate you guys listening to us this year, and I hope you made some good commitments and not sort of resolutions, but more review and planning and looking at how you can focus in on your edges better and compound those in the new year. I find that the way the market's been behaving, there's a lot of persistence of trend during the day. So there is usually a earlier move and then either gets choppy or a bit sideways, and then you might have a resumption of that later on. Occasionally you get sort of hot money coming out in a bit of a reversal, but I do see a lot of persistence of trends in the lower volatility and not as much reversals where, let's say you did a wrong trade and all you need is like, 5 minutes of volatility to get out at a better price or whatever. It's like you don't get that in these kind of conditions. You don't get that absolute reversal. Like if you sat on something in the morning, you were the wrong way on it, and you thought, well, I'll wait for it to reverse and come back. It might stabilize, it might bounce slightly, might get choppy, but to go all the way back to where you got in and should have maybe hedged it or stopped out, we're not seeing that type of action. And so it's not to say that that can't change as we go into the new year, especially if we get some catalysts. But be respectful of what the market is giving you. If it's continuing to be low volatility and these trending conditions are there, then be respectful and try to work with them, or at least deal with the problem early. We get a catalyst that comes along that suddenly roils the market and you got tremendous volatility again, well, then you have to adjust for that. It's going to be different. It's going to swing both ways. Okay. All right, Dave, have yourself a good one. Happy New Year's to you and your family. And thanks again for doing these podcasts with me. I really appreciate it.
Happy New Year. Good luck.